Good morning, it's Glenn here in Tampa. It's 64 degrees. Wanted to talk to you about the volume of interest. It's kind of the key to understanding the infinite banking concept. I think one of the big hurdles that you get over is that you're borrowing against your cash value. And when you do that, you would say, why would I borrow money to pay off a loan? And that's where the volume of interest comes into play. So an example is if you have a $600 car payment and your total cash flow, we'll say, is $2,000. So 2,000 over 600 a month. What does that look like? So you're not gonna take your $2,000 and pay off your car slowly because you're getting penalized by losing liquidity. In the infinite banking concept, what you would do is instead of paying $600 towards a car payment, you would have a line of credit and you would pay yourself $600, but you also have an extra $2,000 to go towards that principal over time. And that $2,000 will knock down your debt expense a lot faster, obviously, with creating liquidity in your system. So that is the whole purpose behind the infinite banking concept. It's like, I don't know if there's any other way to explain that, but you don't pay off your house early because you don't want to lose liquidity. You don't pay off your cars because you're not losing liquidity. What we're trying to create is liquidity to be able to capitalize on other areas of your life, whether it's a business opportunity, a real estate down payment. These are things that come up and then you get rewarded by liquidity, by paying down loans. But in the general loan stance, so you would go out and you'd have like a $30,000 mortgage. I wouldn't pay off that loan until I had $30,000. So what's the cost of that money sitting in my bank account? Or how hard is it to be able to pull, to save $30,000 and not get distracted? So the infinite banking concept is kind of the place to store your capital. You're gaining interest. You borrow against your policy while it's still growing in interest. It's consistent. It's like buying a house and borrowing against your house. The house is still there. The house is still, appreciating. You don't have to take a garage door off to borrow against your house. So you have cash value that's your financial warehouse of wealth that you are borrowing against, and it continues to grow. So you take that line of credit and you pay off these loans that are inefficient in your life. That $600 a month car payment, what you do in the infinite banking concept is you would pay yourself monthly $600. You create liquidity, and everything extra that you have in cash, windfalls or anything that happens in your life, you take that and you flow it back into your policy, which would drive down the total interest cost. It's the volume of interest. And I don't know if there's any other way to explain it, but you guys do a little bit of homework, figure out how much interest you're paying every month. See if there's a way to recapture that. And if you think that, you have any questions or anything like that, feel free to reach out. I'm here, I'm available, I'm out walking. Just give me a call or shoot me a message, and I'd be glad to talk to you about it and answer any questions you have about the infinite banking concept. You guys have a wonderful day, and thank you.